Afternoon, Gary. How are you?
Good, thanks, Leo. How are you?
I'm good, thank you. Good. Gary, thanks for tuning in. We've got some questions for you. Uh, Give me some short, sharp answers. That'd be great, but not too short.
Sure.
Okay. First question. The Treasury is finding it difficult to get money to those people in need. Would some form of universal wage, not credit, make this simpler?
Well, I guess some form of universal wage would make it simpler if it was already in place. But there is a very good reason why the government is channeling its support through furloughing and through the efforts of employers. And the reason is to try and keep the employer in touch with the employee. And the reason for that is so that once the lockdown is lifted, companies and businesses can re-engage with their furloughed employees very quickly, get them back into work and kickstart the economy again. Now, if the government took over paying employees directly, then the contact would be between the employee and the government, and the relationship with the employer is severed. So I think the government have done this in the right way, given the difficult circumstances they find us in. Whether universal wage is good for the long term or not is perhaps an interesting topic of discussion for another time when we're through COVID-19 pandemic.
Sure. Thank you, Gary. What do you think recovery and growth in the markets might look like over the next 18 to 24 months?
That's an interesting one. I think that any investor would do well to try and look further down the line than looking at their portfolios on a day-to-day basis. You can do that with ours, and of course our online facilities make that possible. And the only reason I say that is because one has to focus on what one thinks the economy will look like in the future and what business will look like, as opposed to what's happening now. So there are lots and lots of things to be positive about. It's likely that the pandemic will pass, because that's what's happened with previous pandemics. And because a lot of the problems with the economy are due to the lockdown as opposed to the COVID-19 itself, when the lockdown is removed, a lot of the brakes that are on the economy at the moment will also be removed. So one hopes things go back to normal. So actually, I'm fairly optimistic, and I'm hoping that we would have learned a whole new lot of skills and processes through this time. And I think once we come through it, things will look different. And one example is this. Globalization won't go on at the pace it's been doing, and there will be, I think, an objective amongst all countries to try and bring more production back home so that they're not as exposed to a breakdown in global supply chains. That means that there will be opportunities for certain businesses that are able to do that, and perhaps a few problems for others that may be relying on a lot of foreign cheap labour to make it easier to import cheap goods into this country and resell them.
Mm-hmm. Thanks, Gary. Interesting points. You mentioned online facilities, technology. Is technology changing the way that you're working, yourself and your team?
Oh yeah, technology has changed massively. I mean, you're going to have some people watching this Q&A that have been with us for over 30 years. Now look at what technology has done in that time. They now can have more graphics available with regard explaining what the market and the portfolios are doing. They can go onto our website and get their portfolio value up on screen in an instant. So that's all changed, and we've used a lot of the technology for making things more efficient in the way in which we support our clients. But on the team itself, I think one of the big changes is that it's very easy for us to get our hands on data. So we hook into Bloomberg. You can get current, previous years and years of data on any company. It's very easy to see the shape of a balance sheet, P&L, last year, this year, trends. That's all very, very accessible. It means it's easy for us to see whether a company has got good short-term protection against a market shock, i.e. with their current ratio, their amount of current assets over current liabilities is a good fraction. But one thing it doesn't change is that you still need to be able to be fairly confident in the management of a business before you buy it. So no amount of data out there, however good a company's stats look, will be the only reason for us buying that business. We will also look to see whether we like the management and whether we believe the strategy for that business is right for the future.
Sure. One of the considerations here, Gary, was the evolution in technology leading to increasing amounts of data available and how that affects the work that you do. I think you've given us a pretty reasonable answer there, in that there's always more data, but you have the fundamentals that will never change in making your judgments. Just to add as well that on the side of that we're always looking for ways that we can enhance the client experience, and access to data allows us to plug into the online accounts that we produce for the clients and the investments that we make in that. Now is a fantastic time to be investing in those platforms, so that as we move through this, we've actually created a richer experience for clients, being able to access and manage their investments through technology. So it's all very exciting from my perspective, and thanks for your insight there too. Just one question that I want to ask you regarding the companies that you're looking at, the supply chains. Do you give much consideration, much focus on the supply chains of potential investments?
Yes, definitely. I think in the same way that post the tech crisis taught analysts to look at cash generated by a business. I mean, that was really 20 years ago. That was one of the defining changes. Never mind the P&L and the balance sheet. Does it generate cash? I think one of the things that will be looked at now by analysts is, where does this business get their supplies? If they have to start producing or sourcing domestically, can they do it? What businesses will benefit from more supplies being available domestically? So I think that will be a discussion that we increasingly have amongst courtiers, analysts, and we will be looking at ways in which, when the analyst puts their research together, which we do on every company that we analyse, we'll be looking at whether there's anything we can build into that more formally to make sure that a business that we buy has got its supply chains put together correctly with a good strategy for the future.
Sure. Thanks, Gary. We just had an interruption on the screen there. Forgive me for that. Some software popped up, but we're okay. I want to close with two key considerations, regardless of whatever's going on: the security of our clients' investments and the performance of the courtiers' funds. Are you looking at whether the companies continue to be profitable today? Are you being forced to look a year ahead, 2 years ahead, at how they may be performing and how they may be able to adapt and shift to what some call new normals? Where's your focus on the companies you're investing in?
That's a key issue at the moment. If you only wanted to go onto the market and buy companies that were making money now, you would end up with a portfolio that was heavily weighted towards the modern IT companies, you know, your Microsoft, your Apples, and pharmaceutical businesses, for obvious reasons. So we wouldn't want to fill our portfolio with all the businesses that have done okay in the last 3 months. One of the things that's interesting to us and me in particular, and I think this comes with age, you always know when you get a major wobble on the market that there will be some opportunities. You know, the Chinese word for risk and opportunity is virtually synonymous, and it's a good way of looking at things. So a lot of businesses that we're looking at right now will be the ones that haven't done so well in recently. And there's a few we hold. You know, we still hold IAG, we hold British Airways, we hold Saga. They've not had a great time recently, but we're looking for them to be more productive going forward. But the one thing that is consistent with the companies that we hold on behalf of clients is their balance sheets are relatively good. We want businesses that can withstand a shock, because shocks are as inevitable as day and night. You know, they come along less frequently, but they will come. And when they come, you want that business to survive. Now, we also know that we're probably not going to get every one of those decisions right. So just for anybody watching this, that is why we always diversify over a broad number of shares in the equity portfolios and a broad number of assets and shares in the multi-asset portfolio, so that we do our research, but we also make sure that we're diversified. So if we miss something, it doesn't whack the whole portfolio if it goes wrong.
Gary, thanks very much. That's all the questions we've got for now. Thank you for your time. Thank you, ladies and gentlemen, for your questions. We invite more. Anything you'd like to ask Gary or the investment team, drop us an email or speak to your advisor, and we'll make sure we get those across. Gary, that's all for now. Thank you.
Thanks, Leo.
Take care.